Hey traders, welcome back to another session of Trade Like Assad. Many traders end up losing money not because they lack effort, but because they don't follow a reliable rules-based setup. And without a structured setup, trading isn't really trading, it turns into gambling. That's why today I'm going to share one of my strongest smart money concept strategies, a setup that merges liquidity sweeps, order blocks, and fair value gaps into one complete trading model for A-plus trade setups. And I won't just stick to the theory. I'll guide you step by step on how to implement this method directly on your charts. By the end of this video, you'll have a clear and practical blueprint to confidently apply this strategy in your own trading. We always value your support, so don't forget to hit the like button and subscribe to our channel if you're new here. I'll see you right after the intro and disclaimer. So, let's begin. This effective setup revolves around revisiting a swept liquidity zone combined with the traditional fair value gap. Merging these two concepts builds a high-probability trading framework that works efficiently in both bullish and bearish market phases. In a bullish case, this setup triggers when price returns to an area that has already cleared sell-side liquidity at a key level, such as the lows of a major demand zone, a significant swing low, or a group of lows, and then shows a solid rejection. Once price reacts to the liquidity sweep order block, it typically makes a sharp reversal and continues pushing higher, aligning with the bullish trend. On the bearish side, the same idea applies, just inverted. Here, the setup activates when price revisits a region where buy-side liquidity has already been taken out, like the highs of an important supply zone or a cluster of equal highs. A quick rejection from that level signals a decline, confirming the continuation of the bearish trend. Now, you may wonder, what gives this setup its strength? The reasoning behind it is straightforward yet powerful. Smart money usually drives price toward these key zones to manipulate market participants and generate the necessary liquidity to execute its own positions. This is often done with a sharp move that clears levels above or below, followed by an immediate reversal in the opposite direction. These are the very areas where smart money first positions itself. Their manipulation points formed before institutional orders are fully executed, which is why they hold such importance. Price frequently respects these regions. So, when the market revisits them, institutions often re-enter to protect their positions or complete the rest of their trades. That's exactly why we wait for price to come back to these zones. To maximize results with this trading approach, you'll need to work with two separate time frames. First, use a higher time frame to study overall market conditions and to spot liquidity sweeps along with the order blocks connected to them. The most effective higher time frames for this approach are the 30-minute and 15-minute charts. Then, once you've identified a potential setup, drop down to a lower time frame such as the 5-minute or even the 1-minute chart to find confirmation signals and pinpoint entries. Here's how it works. If you're analyzing on the 30-minute chart, shift to the 5-minute chart to confirm reversals and locate your entry. If you're working from the 15-minute chart, then zoom into the 1-minute chart for confirmation and execution. The beauty of this strategy is that it performs well in both cases. It's simply about choosing the time frames that suit your trading style and applying them with consistency. Now, let's dive into the first trading scenario. In a bullish setup, the first step is to identify a valid liquidity sweep on a higher time frame like the 30-minute or 15-minute chart. You want to see the price take out a key level, then quickly reverse and confirm with a break of structure. Once that occurs, mark the order block that initiated both the liquidity sweep and the break of structure. That becomes your higher time frame point of interest. More often than not, price revisits this order block, acting as a demand zone where smart money re-enters. After marking this block, the next step is to wait for price to retrace into it. That's where the trading opportunity appears. Now, when price revisits your order block, you have two types of entries depending on your approach: conservative or aggressive. Let's begin with the conservative method. When price taps the higher time frame order block, zoom into a lower time frame like the 5-minute or even the 1-minute chart and look for reversal signals. This could be a shift in market structure or a clear change of character, which provides your first confirmation layer. Once that structure shift is validated and you anticipate price to move higher, the next step is to hunt for a bullish fair value gap that forms within the market structure shift leg. These zones often work like magnets, pulling price back before it continues upward. To execute, place a buy limit order at the midpoint, or 50%, of the bullish fair value gap on the lower time frame. For your take profit, target the higher time frame buy-side liquidity. This gives you a precise and high probability trading setup. Now, in the second method, the more aggressive approach, once price taps into the higher time frame order block, the next step is to shift into the lower time frame. At this stage, we're watching for a violated fair value gap that flips into an inverted fair value gap. That becomes your first layer of confirmation. When this inverted fair value gap develops, it often holds as a fresh support zone, creating a strong entry point for a buy position. If a market structure shift occurs simultaneously, it adds another powerful layer of confluence, further reinforcing the setup. With both confirmations in place, we can anticipate price to retrace back into the inverted fair value gap before moving higher toward the next buy-side liquidity. At this point, you'd set a buy limit order at the midpoint of the newly created inverted fair value gap, with your take profit aimed at the nearest higher time frame buy-side liquidity. The exact same principle applies in the bearish scenario, just in reverse. Here's an important tip. If you're trading with the 30-minute and 5-minute time frame combination, both conservative and aggressive entries perform well. But if you're using the 15-minute and 1-minute combination, the aggressive entry tends to deliver better results. Now, let's bring everything together and walk through a live chart example to see precisely how this strategy unfolds. On the screen, we have the US dollar, Swiss franc 1-hour chart. As you can see, after price swept the sell-side liquidity beneath this 1-hour swing low, it quickly returned inside the range, sharply reversing direction and pushing upward. If we zoom into the 30-minute time frame for a closer view, you'll notice that after forming a valid liquidity sweep, price also printed a bullish break of structure by breaking and closing above the most recent swing high. So, everything we need is present here. A clean liquidity sweep followed by an immediate reversal in the opposite direction and a confirmed break of structure on the 30-minute chart. The next step is to identify the origin of this bullish expansion, the precise move that caused both the liquidity sweep and the break of structure. To do that, I'll mark this down close candle, the opposite colored candle, which forms the 30-minute order block and carries the potential to reverse price. This gives us a fresh, unmitigated demand zone, and this is exactly where we want to keep our attention. It's the ideal area to look for long setups if price pulls back into it. Once the higher time frame order block is marked, the next step is to wait for price to return to this zone. Now let's play the chart forward to see what unfolds. As you can see, price retraced downward, tapped into the zone, and immediately showed rejection. Next, I zoom into the lower time frame, in this case, the 5-minute chart, to carefully observe price action inside the 30-minute order block zone, watching for any reversal signs and a valid entry for a long trade. On the 5-minute chart, after tapping the higher time frame order block, price shifted and formed a bullish market structure break by closing above this local structure. This confirms that selling pressure is weakening and buyers are stepping back in. Once the bullish market structure shift is established on the 5-minute chart, we anticipate price to climb higher. The next step is to locate an entry point for a long position. Looking closely, you'll see that price has created a bullish fair value gap within the market structure shift leg. This zone often acts like a magnet, pulling price back before continuing upward. With all rules and conditions aligned, I'll go with the conservative entry, placing a buy limit order at the midpoint of that 5-minute bullish fair value gap, while setting my take profit at the most recent 30-minute buy-side liquidity. Now, let's run the trade forward to see the outcome. As you can see, my long order was triggered, and price reversed upward exactly as anticipated, eventually hitting the take profit. Now, let's move ahead to the next real chart example. Here we have the euro-dollar 30-minute chart on the screen. As you can see, price swept the buy-side liquidity above this swing high and then instantly reversed direction, falling back below the swing high's range and driving to the downside. Looking closely, you'll notice that after forming a valid liquidity sweep, price also confirmed a bearish break of structure by breaking and closing beneath the most recent swing low. So, all the criteria we need are in place: a valid liquidity sweep, an immediate reversal in the opposite direction, and a clear break of structure on the 30-minute chart. Next, I'll highlight the 30-minute order block as our key point of interest, specifically, this last up-close candle before price triggered the bearish expansion. This leaves us with a fresh, unmitigated supply zone, and this is exactly where we want to keep our focus, because it's the ideal area to look for short setups if price retraces back into it. Once we've marked this higher time frame order block, the next step is simply to wait for price to tap into it. Now, let's play the chart forward and watch what happens. As you can see, price moved higher and tapped into the 30-minute supply zone. At that moment, I zoom into the 5-minute chart to carefully analyze price action within the zone. Here's what we see, after tapping the higher time frame supply. Price rejected and simultaneously violated this bullish fair value gap by breaking and closing beneath it, which created an inverted fair value gap. This inverted fair value gap now has a strong chance of holding as new resistance, giving us a clear entry point for a short position. From here, the expectation is straightforward. Price should retrace into the inverted fair value gap before continuing its drop to the downside. With all rules and confirmations aligned, I'll take the aggressive entry approach, placing a sell limit order at the midpoint of that 5-minute bearish inverted fair value gap, and targeting this swing low that formed just above it. Now, let's play the chart forward to see the outcome. As you can see, price pushed slightly higher, triggered our sell limit order, then quickly reversed downward with strong bearish momentum, perfectly hitting our take profit. That's it, traders. Thanks for watching. I hope you gained value from this video. If you did, make sure to subscribe and turn on the notifications so you don't miss any future updates. Share your thoughts or suggest topics you'd like covered next in the comments below. Your support truly motivates us. See you in the next one.